Francis Tan is a chief strategist Asia at Indo-Suez Wealth Management. Francis, it's great to have you on. Good morning.
Good morning.
So let me ask you, are you trying to see through all these Trump-China tariff-related headlines, or did you make some major moves? What did you buy? What did you sell since April 2nd?
Well, since early April, certainly we saw lots of risk aversion in the markets, and that saw a big sell-off, particularly in American equities. One of our approach right now is to really weigh the impact of the tariffs of the US against the rest of the world. And what it means is that we believe that China and many other countries in the world are better able to weather the upcoming tariffs against them rather than US itself. For one, tariffs against the other countries will slow down US GDP. Economic growth is going to slow. I mean, I often get the anecdote that if the next iPhone is going to be a lot more expensive because of the tariff, the average consumer in the US will just simply delay purchase. And their consumption today, the lack of consumption today, will mean revenue is going to slow down. So US GDP growth, overall economic growth is going to be much more impacted by the tariff than the other countries. Now, the OECD trade in value added shows that China's exposure in terms of its exports to overall final demand of American is only 2.8% of China's nominal GDP. So I believe that going forward, China will be very much able to weather this. And because of that, and also because of the valuation that we're seeing in China, we continue to maintain an optimistic stance in Chinese equities, while at the same time, we have pared back a little bit on the US equities from a previous slightly overweight to neutral.
Yeah, so I see that. You are moving to neutral equity stance. You're actually moving to underweight duration in the fixed income space. And you're also reducing your overweight call on the US dollar to neutral. So you're not really liking any of these assets, or is there a bright spot?
Well, certainly, other than what you have just mentioned, Sherry, the other thing is that we still prefer investment-grade bonds over the high-yield space. We believe that the world, especially the acceleration of the move into the late cycle of the global economic cycle, is continuing right now. I mean, even if Trump didn't come up with the tariffs against the rest of the world, we will already see the US plus many other countries in the world in a later stage of this economic cycle that started from 2020. Now, if we are in a late stage of the economic cycle, usually it's a situation where we are going to be neutral on equities or even some slight underweight on equities. We are going to be overweight on fixed income. We will love IG more than high yield, and of course some higher weightage in gold as a safety hedge. At the end of the day, it's hard for us to know when the end of the cycle will come. Although we are late stage, it's hard to know when the end will come. But right now, I think it's important for portfolio managers and even investors to look at their overall portfolio allocation and be more prudent right now, just to be a safety, just to hedge against the impending future.
And yet, your base case is a non-recession scenario. So what do you want to see to be able to feel the less compelling case for diversification, or for you to move from investment grade to high yield when it comes to credits?
Well, I guess before the upcoming recession comes, it's really hard for us to move from investment grade to high yield. At the end of the day, the economy runs in a cycle. Life goes about in a cycle as well. What I want really to see is that the impact on the real economic numbers. In this case, we are seeing US unemployment as one of the key numbers. Although it's a lagging indicator, but it gives you a good sense of the economy. Of course, last week's non-farm payroll seems to be still robust, but increasingly we are seeing an upward climb in the unemployment rates in the US. And that again showcases and cements that we are in the later part of the economic cycle. And again, when we are in the later part, it's always prudent to be really more on the defensive side. If you have to have exposures in equities, do so in more of the defensive side, so utilities, your healthcare. Otherwise, just go for high quality fixed income.
Francis, great to see you, and welcome back to the show. It was a pleasure to have you on. So, we had Kristen Welker talking to President Trump on Meet the Press on Sunday, right? And she asked him about Powell and the Fed. And he came out and said, no. Why would I do that, right? When, in short order, I can replace the guy, right? So this should be giving the market a little bit of comfort. Does it give you comfort that Powell is going to be in the job until his term ends, at least.
Okay, well, it doesn't really give me any surprise. I believe Powell will still be in the job until his term ends. Yeah. What matters more right now is not the rhetoric between Trump and the rest of the world or even against the Fed. What matters now, again, as I mentioned just now, critically, is where we are on the economic cycle. If we are diligent on looking at where we are on the economic cycle, we are actually cancelling away all the noise from the signals that's coming. And for me, as an economist as well, I really rely a lot on the hard data. And hard data is saying that although everything is still quite robust, but it's pairing off at the margins, basically. Mm-hmm.
So the latest data on Friday, right, the jobs report came in much stronger than expected, right? And markets were looking for 3 cuts from the Fed this year, but I suspect that after that jobs report came in with a stronger print, they're probably thinking maybe fewer than 3. What are you looking for?
Well, actually, if you look at the interest rate futures market, it's certainly always flip-flopping. I mean, at the start of this year, it was taking perhaps no cards or even 1 card. And then because of the sell-off in equities in early April, there's 3 cards or even more than 3 cards. So the futures market certainly is expectations of interest rates flip-flopping. But guess what? At the end of the day, we are still slowing down from the typical high that we are seeing back 1 to 2 years ago. Like I mentioned, everything is again on the economic cycle, right? Yeah. And what we can think of it now, do you think unemployment is going to go back to the 3.5% peak at 2 years ago, or it's going to get worse from here? Yeah. My feeling is that from the tariff against the world, plus the overall slowdown in the whole year's economy, we are likely to see higher. I mean, in one of the FOMC's power think that the unemployment rate in 2025 could reach 4.4%, and that's from around 4.1% right now.
So when is this going to bite the hardest? We had a guest earlier this morning telling us that it's probably going to be the fall in the U.S. when it all culminates in a lot of pain on not just the economy, but on companies, on workers, on consumers as well. And that is when a couple of things could happen. Probably more pressure on the Fed more than ever to cut rates, and 2, more likelihood of a U.S.-China trade deal. What do you think?
Oh, yes, certainly. We have seen some softening already over the weekend about the potential of a better trade deal between U.S. and China. It's really a situation of who blinks first. And in this case, in this game theoretic approach right now, I'm not seeing China blinking at all. I mean, China today, 8 years later, is very different from where they were. China has got a lot more at the table that they can play as well. Yeah. So perhaps we are going to see Trump or the US blinking first, and that could really bring things to be on the softer end for the rest of the world. Things will not be so uptight, I think, going forward. Yeah.
How much weaker is dollar going to get, do you think?
Sorry?
How much weaker is dollar going to get?
Well, I believe in the near term, tactically the dollar has gotten quite weak. There may be a little bit of a rebound, but it really depends going forward how the tariff is going to be. Technically, if a country is going to tariff on other countries, your own currency should strengthen. But this is not exactly what we are seeing right now. Yeah. So seems like the rule book has been thrown out the window.
Oh dear. Sure.
Yeah, and Francis, we were just having a crypto conversation. I wonder if your clients are asking questions about crypto, just because the world is trying to find a great diversifier, just like gold.
Oh, yes. Certainly, especially in early April when all the risk assets start selling off, everyone is trying to look at what are the defensives, what are the negative correlation, what are those that are not even correlated. Some clients do ask about crypto, but of course there's a whole big thing about crypto that you can talk about them really being a store of value, especially when it's so volatile. The basic functions of money seems not to be in crypto. But however, there exists a lot of the other opportunities out there. I mean, other than gold, but gold has been a bit of a high side. Clients are looking at private markets, they are looking at hedge funds, they are looking at things that are a little bit not so correlated with the public market. So increasingly clients are getting more educated and they are finding out more about such. And especially when I mentioned that we are now defending our portfolios against the impending recession, which I do not know when it's going to come, clients are increasingly trying to buffer up. And at the end of the day, we treat this as something like an insurance on your health. Well, when you are healthy, the insurance premiums are cheaper, right? And right now, some of these defensive are, I believe, of a good price that clients should really, or investors should really look at to buffer or to prevent themselves from falling into the recessionary trap.
So what is your favorite alt as a great diversifier? You singled out gold in your note. Is it gold? I mean, If you're talking about use cases, it's heavily as of the industrial use metal as well.
Certainly, gold is one of the good use case as a safe haven. But otherwise, in some of the currencies are pretty safe havens. The Japanese yen stood up quite interestingly as well, as the world moved a little bit away from the US dollar in April. The Swiss is as well. However, I still put a little bit of emphasis on private markets. I really believe that any investment or portfolio should not avoid private markets allocation. In fact, investors should look more into private markets, learn more about them, find out more from your financial advisors, and at the end of the day, increase your allocation to private markets, because at the end of the day, it's a really strong diversifier and stabilizer for portfolios across the economic cycle.
So private markets, that would include PE, would include private credit as well.
That's right.
I agree that theoretically they would be a potential portfolio diversifier, right? But with the likelihood that rates and inflation are going to go up, it's usually not good news for that space, no?
It really depends. For a lot of the private markets, when interest rates are going down, it's actually a little bit better as well for them. Because at the end of the day, the cost of funding goes lower, it should be supportive. But the main thing is that it really depends. In the private market space, we are more interested, we are more optimistic in the secondary listing space. That is one of the space that in Indo-Suez we believe has got an advantage in a portfolio. Secondary listings, that's right.
Why so?
That means you're going into the private markets, going to an individual investing company, but not bringing them to IPO, but basically going into them.
This is a private placement then you're talking about?
No, just basically perhaps perhaps going into the private companies and selling them to another GP. That's right.
All right. Okay, Sherry?
Yeah, and Francis, I just wonder what you feel. I mean, I know that you did say that you prefer investment grade over high yield credits when it comes to the fixed income space, but just can you break it down for us, your favorite part of this space as well, just because the U.S. Treasuries got burned about a month ago, and that sort of brought on lots of questions about U.S. exceptionalism, not just about the technology, but really the idea of the United States, the capitalism. Is that going to benefit your space here in Asia?
Well, at the end of the day, if you look into a broad portfolio, the allocation to US dollar, hard currency, fixed income has got its own status over there. But on a shorter term tactical basis right now, we're actually more optimistic in the European sector. Right now, we are in fact increasing our weightage on the European equities, as well as looking at some of the interesting European fixed income, some bonds right now, mainly because of, we believe, a better economic condition in Europe going into this year and also into next year. So a good time also for those with, I would say, too overly allocation into a US dollar space to move a little bit into the European segment. All right,
Francis, listen, fantastic to talk. Thank you so much for dropping by. Great to see you. Keep safe and come and see us again very soon.
Thank you very much.
Pleasure is ours. Francis Tan there from Indo-Suez Wealth Management joining us live this Monday morning.